All right, guys, as you know, cash flow gives you time and money freedom. We're going to talk about how to create the cash flow process today with Jennifer Hernandez from Liberty Mutual Mortgage in Houston, Texas. And what we're going to be talking about is different types of loans, different types of qualifications for these loans, and changes coming up. One that just happened here on December 7th that are going to affect your business. We're going to dig into this in detail. We're going to start kind of basic and we're going to work our way up. But this is important. If you want to be a cash flow investor, you need to learn how to create the cash flow, and that comes from debt service. Jennifer, welcome to the call. How you doing?
Yeah, thank you. Good, thanks.
Yeah, so you've done a lot in the business. You've done thousands of loans, billions of dollars of loans. You've been in the business for almost 25 years. And we're going to talk from a position of credibility here. And you have a lot to talk about when we come into the mortgage business, when we're looking at the mortgage business. Let's go ahead and kind of let you introduce yourself, kind of tell us how you got into the business and how you got here. And then let's dig into anything and everything we can to help these investors understand the loan process.
Okay, cool. Yeah, Jennifer Hernandez, Legacy Mutual Mortgage. All my handles are Loan with Jen, Facebook, Twitter, YouTube. I have a YouTube channel that Connor inspired me to get going more avidly. So Loan with Jen, LOAN, and then with Jen, JEN. So in the 24 years career, I'm really proud of the fact I've only been with 3 companies. So I'm with my 3rd company. You know, it's super common that loan officers move around. I stay the course. Grass is not always greener. So I'm super committed to being the best that I can be in my profession, doing it really, really well, like go big or go home type of mentality. I've had a team for I've had an assistant for 16 years, but we were just a 2-man show until about 10 years ago. We started to amass 2, 3, 4, or 5 people. So I've got 5 people that support me now. The thing that's created, and why I think for investors or any homeowner, a team is really important, is that all roads don't lead to me. So I've got an educated, well-trained team that at every turn we can handle your needs, because things are going to come up, you know, there's going to be turbulence on the plane, right? So we can land it smoothly because we all pull together to get the job done. So it's been super fun. And it's allowed me to spend other time of just educating and getting my voice out there to get real information to people, but I've become super passionate about. So sums it up about me. Thanks for having me today. It's a great topic. Investors, it's super fun. We help them from 2 different angles. We help them amass properties that they're going to hold and rent out. And then we also, on the other hand, support them when they are flipping properties. They'll tell the buyer, potential buyer, whatever kind of loan they're doing, like, hey, we're happy to look at your offer, but unless you get a second opinion, red light, green light from Jennifer, we're not going to take your letter seriously from XYZ lender. So we
Right.
really help investors know from all angles that the letter or the buyer that they're about to put under contract has credibility. So that's another angle for investors that we are really good at providing as well.
Great. Let's bust up some myths. There's a lot of disinformation out there. You hear it all the time. You go to local REI clubs, and everybody's got their own opinion. But let's get it from you. Let's start off basic here. Let's talk about FHA loans, and then let's talk about in comparison to conventional loans. Then let's dig into all the qualifications and look at lots of different things, debt to income, reserves, all the different things that we're going to go over are going to be interesting for you guys. So first off, what is an FHA loan? And let's kind of go over some of the myths about this, because a lot of people think they can just go get multiple of these loans as an investor, and that may or may not be the case.
Yes, that's a perfect way to lead into it. So FHA loan stands for Federal Housing Administration. So it is a loan that is sponsored by the government. It's very heavily regulated. The purpose of an FHA loan is to help homeowners get into a home that wouldn't normally qualify. They're super lenient on credit, super lenient on debt to income. You can go up to 55% debt to income. Very lenient, no reserves required. Like, it's like the easiest loan to get into. Pretty, like, if you're breathing and you can get a Texaco credit card, you can probably get an FHA loan. They're lenient on bankruptcy. You only have to have 2 years bankruptcy and reestablish credit. So that's why someone would get an FHA loan. Now, the myth that it sounds like some of the investors might have is that they can go get a plethora of FHA loans. That is not correct. FHA is only for a primary residence. You cannot do an investment FHA loan. Now you can do a duplex, so you can be purchasing to live in one side and then you're going to rent out the other, for example. You can do a multi-unit. So probably if you're an investor that's going to amass several properties, the very first property that you get, like let's say you're renting now, or let's say you have one property that you live in now and you're going to leave it in place and rent it out and you're going to move to the next one, you're probably only going to be able to do one FHA loan, more than likely, because you do have to show before you get the next one, because I know, Connor, I see your mind racing already that you're going to ask, well, how long do you have to stay there before you can get the next one? It's up to interpretation. It's a very gray area, but most of the time it's 1 year. If you start amassing properties and you're in an FHA loan and you're going to go to the next one and try to do FHA on that one, it starts to send a red flag. Number one, you can only have one FHA loan at a time. That's the rule. Unless you're relocating to another city or you're divorcing or some other extra circumstance of why would make sense that you have two FHA loans, you can only have one FHA loan at a time.
Okay.
So let's say you acquire the FHA loan and you live there a year and you're going to go to the next property. I mean, the rest of your loans are going to be conventional, more than likely.
You can get up to a 4-unit property, right?
Up to a 4-unit property. Yeah.
Right. So I'd advise if you're going to do as an investment, go get the biggest one you can. I think that y'all just changed FHA requirements. What is the total loan amount they'll go up to now? Isn't it like 500?
It'll go up to three. It's currently 330. It's like 330,050. It's some weird number. So it might change. Conventional just changed to 510, 400 as of January 1. FHA has not made an announcement yet, but it usually goes hand in hand. So we'll announce that as soon as we've got it. But that's currently in Texas market. It's 330.
Okay, yeah, that's what I thought. I saw something the other day that went up to 500. I guess it's conventional. Okay, what is a conventional loan in relationship to an FHA? Because also, guys, we didn't mention one of the big benefits to getting an FHA loan, which is why you'd want more of them, is not just the easy qualification, but the low down payment, the less disposable income you need to bring to the deal, which is about
So conventional loans, from the perspective of an investor, I'm just going to go at the perspective from I'm an investor. I have my current residence FHA loan or other loans. I already have 2 or 3 properties and I'm buying an investment. The minimum down payment that we have, that any conventional loan has, is 15%. Now, there might be some hybrid lenders out there that have higher rates and all kinds of points and stuff like that might be 10. I don't carry any of those. So I'm not saying they don't exist, but for the conventional 30-year fixed rate, non-ARM type stuff that's the least expensive with the sexiest interest rate, it's going to be 15% down.
Okay. And so what are typical rates that you're seeing in the market right now? I know they dropped a little bit. Maybe you want to talk about what happened last year where they kind of went up a little bit and now they're coming back down. Kind of give your take on that.
Yeah. So right now for investors, the rates are they're in the high 4s. Now, I say that with very high overview. It's going to depend on the credit score. So on conventional loans, you asked what one of the main some of the differences are. Conventional, unlike FHA, is very, very, very driven by the interest, but what your credit score is. So if you're below 720, really if you're below 760 as a credit score, you're middle of your 3 credit scores. As your credit score goes down to a lower amount, you're just going to get hosed on the rate and the points. So It's hard for me. I can't, we'd be here all day, really over an hour if I gave you every rate of everything. But what starts to happen is, let's just say you have 760 credit, you have great credit. You're probably going to look at, like right now, around 4875 for a 30-year fixed. On a 15% down, you're probably going to pay 2 points. 20% down, you're probably going to pay 1.25 points as additional closing costs, just because that's just how those loans are pricing. And the sweet spot for investment properties is 25% down. So depending how much cash you want to outlay, depending on a lot of different things, that kind of gives you a guideline of how those loans are priced.
Okay, and so points, you mean points up front as a
Yes.
percentage of the loan. And then what other fees would be associated? Let's say I came to do a loan with you, $200,000, and I was 2 points up front, right? I want to pay
Yep.
4,000 up front. Then what are some other fees associated with that they can expect?
So for every loan, regardless of the loan amount, the fees between us and title, survey, appraisal, all that kind of stuff is right at about $3,700. Let's just round it up for 4,000 because it's easier math. Okay, so let's just say 4 grand between all of the different parties that make it happen. Then you would add those points on top of that. So just to reiterate what points means, 1 point is 1% of the loan amount. So if the loan amount in your example was 200,000, 1 point would be 2,000, 2 points would be 4,000. So you'd have your, conveniently, coincidentally enough, the 4,000 in regular fees like title, our underwriting, flood certification, credit report, all the normal stuff that everybody has. That's 4,000, and then your points would be 4,000 on top of that in this case. So that's 8,000 total.
Okay, so I hear that sometimes, investors come to me, they say, I can only get 4 loans. I can't get more than 4 loans. But how many loans can they get up to if they go conventional? Where is it getting tougher? And why would it be tougher to get 4 up to 10? Or kind of give me your take on this and kind of break down what the actual truth is.
Sure. So it is, every different lender has their rule of what they want to do. Fannie Mae and Freddie Mac will go up to 10. Okay, so they'll allow up to 10, but it doesn't mean that every lender will go up to 10. Different lenders just say, you know what, we don't want that kind of business. We just don't want that in our portfolio, so we're going to max it at 4. Okay, so they either do 4 or they do 10. I've never really seen anyone be like, oh yeah, we'll accept up to 6. Like they either do one or the other. So legacy will go to 10 for sure. So when you're qualifying, as you assimilate properties, and we're qualifying for that, we can use the rent from all the other properties. We're going to look at your tax return for the properties you've owned more than a year or two. And then let's say you've acquired properties since then. Let's say we're in 2019 and you acquired some properties in February and you just don't have a tax return on it yet. We're going to take 75% of the rental income. So let's say it's rented for $1,000. We'll take $750 and we'll use that to offset the payment on that property. Does that make sense?
Okay.
Okay. So when we're qualifying, we're looking at that. Your whole debt to income on any conventional loan cannot exceed 50%. That's 50%. And then another important factor that's really important to note, and the reason that we see many investors start to not qualify is reserves. I mean, investors, let's face it, they're putting their money into other properties. Like capital in equity in property is a big source of their net worth. Lenders do not recognize that because it's not if you got into an emergency and had to dip into your reserves, your savings to make the payment because you lost your job or source of income or you lost a tenant or whatever, we want to know that that money is liquid, that it's cash. So it can be in your 401k, it can be in a savings account. It has to be some type of asset that's able to access quickly without selling a property. So reserves, you need anywhere from 6 to 12 months of reserves, depending on how much you're putting down on the new property. So if you're putting only 15% down, which really isn't that much, we're going to want you to have 12 months reserves on all properties that you own. You want me to go over what reserves means, what that means?
Sure, you can break it down. I think someone here would.
So reserves means that you have sitting in some type of savings somewhere, not to be spent, but just sitting there, 12 months in this example, of the PITIA, principal, interest, taxes, insurance, and association dues, prorated to a monthly amount for all the properties that you own, including your primary. So that starts to add up. If you've got 5 properties, right? Times, $2,000 a month, let's say, that's 10 grand a month times 12, that's 120 grand.
Jeez. What about a credit line? Will they look at that? How will they look at that? Let's say you have
No,
100.
we won't use credit lines. It's got to be it's got to be hardcore liquid assets, savings, stocks, bonds, money market, 401k, SEP account,
Now I know what
cash value in a life insurance. Could be that.
I know a lot of investors are creative. They're probably thinking, does this have to be proven? Are they going to look at my debits and credits? Are they going to look at how long it's been in there? Or is this something I can put into account for a day and then extract? Or how does it?
That's an excellent question, actually. It cannot just show up. It has to be seasoned for 60 days. And any large deposit, like let's say, Connor, I looked at your asset checking account statement and you just all of a sudden, because I'm going to ask you for 2 months, and I saw that 35 days ago you had this miraculous all of a sudden deposit of $60,000. I'm going to say, Connor, fantastic, we're going to meet the reserve requirement. Well, I just need to trail where that 60,000 came from to make sure that it's an asset that was yours to begin with. So I'm going to ask for proof of where that deposit came from. So it has to be from an acceptable source, which would be some asset of yours that you sold, like a house or a motorcycle or a yacht, or, you know, I'm making stuff up, but it has to be from something. It cannot be a gift. Investment properties will not allow a gift.
Okay. What if you hit the requirement that you was 2 months qualified, and let's say you needed $60,000? What if you're taking part of that $60,000 to throw down as your 15% into the loan that you're getting? Can that count, or is it, do you have to have the 15%
no, after
on top of that?
On top of. So you need, what we have to verify for your cash to close, we have to verify your cash to close, which is down payment plus, you know, closing costs. And then in addition to that, we have to verify, so let's say down payment plus closing costs is, let's just say it's 30 grand. In addition to that, we need your reserves. So if you put 20% down or more, reserves are 6 months. And if you put 15% down, if you go the low down payment option, it's going to be 12 months, more than likely.
Now you hear this battle back and forth between certain investors. Everybody's got a different mindset, 15, 20, 30 years. What are you seeing typically most investors do? Are they going with a shorter term loan to pay less interest over long term, but make less cash for the day? Are you seeing them go more with a 30-year loan? And are they qualifying?
You know, the amortization is almost always 30, almost always. Where we see the difference, and it really depends on the person, is the 15 or 20% down or 25. Like, I always just let them know, listen, 25 is your interest rate and point sweet spot. But I'll show them a chart really quickly. I'll say, hey, here's 15 down, because you've got PMI too. We haven't talked about that, but that's private mortgage insurance, which is an additional cost. We've got 20% down and we've got 25% down. So I'll show them those 3 points so they can see the payment, monthly payment, and they can see the cash outlay. And honestly, probably the experienced investors that have multiple properties will choose the lower down payment and the 30-year every single time, because they're all about cash flow. Some of our newer investors just seem to say, I mean, it really just depends. Some will say, no, I want the 25% down. I want the lowest rate, the lowest points. It's going to depend on what the rental cash flow is, right? A lot of it depends on that, of where we get the sweet spot on that monthly payment so that they're cash flowing every month. So okay. I see it all across the board is the answer to your question.
Now, some investors may have a little bit more money today and they may want to pay less over the career tomorrow. What does it look like? Are they able to buy down points on these loans? Are they able to purchase at closing? Is that
you can, depending on how much you put down. Like if you're putting 15 or 20% down now, you've already got points on there. So buying down more points starts to become the law of diminishing returns. Like, you know, when we see we sell loans to like 12 different investors, like Chase, Wells, all the big guys, PennyMac, all those. So when we see their rate sheets, if we start to see the 2 and 3 point buy downs, it starts diminishing the benefit. Like instead of 1 point getting 1/4 to 3/8% in interest rate, it starts to get 1/8, like it to where it just doesn't make sense. So we just have to analyze what the market is bearing. I don't know if that, I want to hope that I'm trying to make it simple so that it makes sense, but we'll show people buy down to points, but I've rarely had an investor do it because they're having to pay points already if they're putting just 20% down. If they don't put 25% down, you're paying points anyway.
Okay.
And that usually eats it up pretty good.
Now, you've seen a lot of people come through as an investor to get a loan. What are the main reasons, the number one reason you see people not being able to qualify? What is it that most of them struggle with? What part of that qualification process?
The number one reason in investors, I would say, is that reserve requirement. That's really number one. And number two would be credit. If you're buying an investment property and your credit's not in the mid 700s or above, your options become super limited. In fact, if your credit score is below 680, it won't even price you. Like you'd have to buy down like 5 points. Like the points to be able to, the overlays and the pricing risk factors are so severe when your score goes down, 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 that it like ginormous amount of points to buy it down, and it just doesn't make sense.
Now, when they're looking at credit score, do they do a rolling credit score? Because a lot of investors are using credit lines or they're using business credit cards, and they may fund the gap and take some money out of their pocket, or they're funding repairs, and their credit score may go down and up and it bounces around like a ping pong ball. So will they look at a snapshot of the day of the application for the loan, or do they look at it over a 12-month period, over a rolling period? How does that kind of look from your side in?
Yeah, that's a great question. No, it's we pull from all three bureaus and all mortgage companies that are using the conforming model anyway. We have to pull the same version of credit score. You know, FICO has about 25 different scoring models. So if you say, hey, Jen, I know my credit score, I got it on Credit Karma, that's not what we're going to pull. It's just different. So we take the middle of your three scores. So when I pull Connor's score today, you know, December 10th, that's exactly whatever your score spits out that day, that's what we're using. So it is whatever it is on that day. Now, if I see that there's room for improvement, and I say, hey, you've got some disposable cash, let's use it to pay down this credit card over here to where you're less than 30% of the balance, you'll boost up 40 points, we'll get you a better rate. So if there's room for opportunity, I'll try to seek it out to let you know. But answering your question, it's today's score right today as it is today. Okay.
So some investors are using a loan to acquire the property on the front end, but a lot of them are doing a strategy where they buy the property with an interest-only loan, fix it up, and they come back to you for a cash-out refi to hopefully not have to leave some of that money in there and avoid that 20% down if they're in their leverage at the position of appraisal. Is there any difference in how you look at a qualification when you're looking at them, if they're buying it on the front side of the loan or if they're doing a cash-out refi, and how does that kind of compare?
Yeah, that's a great question. So, because I've got that as well. They'll buy it hard money or whatever kind of loan, and then we'll come out. So if we're doing on a refi, there's two types of refinances. There's a rate and term refi where you got a hard money loan and they lent you the money for improvements, and we're just going to do whatever the payoff balance is. Like let's say the payoff balance is 110. We'll use the appraised value, whatever it is, fixed up, right? So let's say it appraises for, I don't know, 180. We'll refinance the 110 plus the closing costs. So as long as we're below that 85% loan to value, we're fine. The cash out, we've got to wait 6 months to use the appraised value. So that's a really important question that you brought up, because you know, it's important for investors to know if you're wanting additional cash out, if you just have a property you got a great deal on and it's just a cash cow and you're able to rehab it for a really good price, to get into that equity, we've got to wait. It's called lenders call it a cooling off period, to just make sure that we're not cashing out on inflated values. So we want a 6-month kind of evening out period, and we'll only cash out up to 70% of the value.
Okay, 70%. So that's if you put a lien on the property and borrow from a hard money lender. Does it change if it was funded cash out of pocket? I've heard that you can do a quicker refinance. So let's say I bought the property with my own cash or credit line. There was no lien on the property. Do I still have to wait for the 6 months seasoning period?
Yeah.
Okay, because that's kind of been
Yeah.
fun.
Anytime we're not paying off a real estate, like a deed of trust lien, it's considered cash out,
Okay.
line of credit or whatever.
Now, there's some interesting things happening in the loan world, right? So on December 7th, there was a change up. What happened there?
Yeah, December 7th, what's happening is that Fannie and Freddie announced they made it more strict on how they're going to count or not count rental income when you're departing a residence. So it doesn't matter if you're buying a new primary, a new investment property, it doesn't matter what you're doing. If you don't have a history documented via tax returns or rental agreements, that you have a history of being a landlord. And it can be even a history of just one property. Like, you don't need this elaborate history. But if you don't have a history of managing at least one other property for rental, we will only allow you to use the upcoming rental income on the residence that you're departing up to the PITI. So I'm going to give you a real life example. Well, I'm going to make up a real life example. And so, Connor, you're my client and you are living in a primary residence and it's an FHA loan. Let's just say you got it 3.5% down a year ago and you're like, all right, I'm going to buy a new primary. And you say my payment with tax, insurance, homeowners association and everything is $1,500 a month. And I'm going to go to buy this new house, and I'm on this house that I pay $1,500 a month on, I can get rent of $1,800. And let's say that you want to use some extra income to qualify. So we take the $1,800, I'm getting my calculator out. So we're going to take $1,800 times 75%, and that's $1,350. So we're only going to use $1,350 to offset your $1,500 payment. Does that make sense?
Okay.
Okay, so let's say on the reverse, let's say that it's $2,100. Let's just say you pay $1,500 a month, and let's say that the rental income is even going to be higher, and it's going to be $2,100 a month. So we take 75% of that, which is $1,575, and your payment is $1,500. We're only going to allow the $1,500. We're not going to give you that extra $75 credit towards qualifying in your other income. That's not really a big deal. It's only $75, but I've got some clients where their own property's free and clear, or you've got a huge disparity and like there's like $500 or $600 of extra revenue rental income in there that you want to use to qualify to help you buy this other property, right? We can't do that if you don't have rental history that we can document. We can only use that 75% of the rental income number up to your payment and no more. We can't give you any additional credit over that $1,500 that's paying your current payment.
I mean, it's going to affect a lot of people because the market's been appreciating so much since 2011-12. They could have got in at a very low loan rate, and now the property values have gone up and rent rates have increased so dramatically. Now, what about appraisals? Let's kind of talk about this process. I hear a lot of fights with the lender and the appraiser. How often does this come up, and what do you look at when it comes to appraisal, and can they get a reappraisal? And kind of give me your take on this and what you see.
Yeah, no, perfect. It is important to know whether you're purchasing a property or you're selling one. So investors in general, when it's an FHA loan, you didn't ask me this, but I want to put it in here. An FHA loan, when there's an appraisal done, it sticks with the property. So it sticks with the property for 4 months. So you can use it to your benefit. Like, let's say, Connor, you're doing an FHA purchase. It's going to be your primary. And later, a year later, you'll leave it for investment or whatever. let's say you're buying it for 150 and it appraises for 140. Well, that's leverage for you to negotiate with that seller to be like, look, dude, you might as well lower the price to 140 because this appraisal is going to stick with the property for 4 months. You're going to be handicapped and you're not going to be able to sell it to anybody else. Like, don't be stupid. Okay. So that's point number one. On conventional appraisals, we get appraisals that don't meet value sometimes, and Legacy is very friendly to the rebuttal process. So we send, it's really the proper term for it is reconsideration of value. And I'm going to send you a document if you want to post it in comments or something. I'm happy to send it to you. Reconsideration of value. It's just some tips from one of our top appraisers that when you are writing up the data for a reconsideration of value, it gives tips kind of what to do and what not to do. So you've got to be prepared that if you're going to fight an appraisal and say it comes in at 140 and you really think it needs to be 150 to make the deal work, then you better give some good hard data as to why or why not, some other comps that they're missing or whatever. Okay. So if it doesn't meet value and the seller won't renegotiate, you would have to, like, let's say you're doing a 15% down loan. Okay. We'll do 15% down from the 140 and you'll pay the difference from 140 to 150. So you can buy the house. I mean, we're going to approve you. You just have to come up with the difference.
Right.
Yeah.
Now, days to close are very important for investors because, let's say, property is $150 a day to carry. So how fast, what typical loan period can you get a loan closed in right now? Is it 21 days, 30 days? 30 days?
Legacy, we're like 25 days probably. 20 to 25, just depends on the time of the month. But, I'd say 3 to 4 weeks is fine.
And as far as the market goes right now, what are your perceptions? Because you get to see a lot of data that, a regular investor that buys a couple properties even doesn't get to see on a high volume. Are you seeing the number of loans go up, down, flatten? What is your take on where we're at the state of the market?
Right now, the interest rates are super healthy. So, we're super busy. This is the busiest end of the year that I've had in a while as far as, I'm closing a normal amount in December, but the forecast of what we're starting to book for January is like, it's up like 50%. Like it's the buyers are out there. The market is fluid. I think rates do have something to do with that. I've heard from some mentors and, my boss and some people that follow the market a lot, very heavily, that the run is going to last probably till summer with the rates. And then, it's evident we're at the longest run of a good market. We're at the 10-year mark. So, it's going to happen. So as soon as the presidential race starts to become clear of who kind of a clear winner is, so it might be summer, it might be fall, we don't know, the market is going to probably go up. The stock market will be better. There'll be more certainty, and I think we'll see the market go up. So I think that healthy rates does have a lot to do with what we're seeing right now. So it's a good time to acquire and sell property, for sure.
So rush out there and get as many loans as you can right now, guys.
Yeah.
That's pretty typical from what most people's opinion is right now, is that we're going to kind of battle through this winter period and get through summer and have a good spring and summer, but then get ready because nobody really knows what's coming. Now, I was in the car the other day and I heard like 500 credit score loans, potentially stated income loans. I thought all this stuff was going the wayside, that this couldn't happen anymore. Are you seeing anything like this, or?
I've seen the announcements for a while that stated income. There's hybrid investors out there. So I'm really, really fluent and good at the run of the mill Fannie Freddie stuff. I have a few hybrid products, like once you go over 10 loans, there are loans, and I do have one investor that'll do more than that. I did one. It was a total pain in the butt. Like, oh my God, be prepared for requirements and paperwork, and it's super hard. Like, they put the screws on big time as far as just how to qualify and all that. But they're out there. The stated income, yes, I think they're out there, probably super high rates. We have a bank statement program. It's like 7.5%. I mean, you might as well do hard money at that point. But anyway, yes, those loans are out there. Yes, there might be some people that do 500 credit score, but it's like less than 5% of the lenders out there for sure.
And then do they have a cutoff? Like you can get unlimited loans as long as you hit the qualifications. And are they probably asking you to leave a better position for them as far as loan to value? They're looking for what, 65, 70% or less, or?
No, I don't know the answer to that. I have a feeling that those programs are probably only for primary residence purchases and not investment. So my guess, my educated guess would be that investors probably wouldn't be able to take advantage of those types of really super, super hybrid programs. Too good to be true.
What about like blanket loans and group loans like that? Are you able to take, let's say, 10 conventional loans, you had all these properties, and wrap them into one loan?
No, that's a good question. I'm not. I'm just more of the straight conventional route. So, in fact, you bring up a good question. So conventional loans, you've got to be the name of a human entity. So I get a lot of investors that say, oh yeah, I want to acquire in the name of the LLC. You've got to acquire in your personal name. And so work with your attorney after that. If you create a trust and LLC is a beneficiary or something, you can do that, or you could transfer it to the LLC. Fannie Mae actually allows that now, I think. So talk to a real estate attorney. But you bring up a good point about the blanketing. If someone needs to blanket the loans like that, I have some bankers that I can refer them to. If I can't do a loan, I always try to refer to someone that can help them. But commercial banks are the only ones that I know of that'll do the blanket type loans.
Okay, what about a construction loan? Is this something you do, or is this something you know about?
We don't do construction, but I have some bankers that I know that I'll refer to do the construction, and then we'll take out the permanent after the construction is done. But they are only looking for primary residences, so that's why most investors, from the investment standpoint, we're seeing them do hard money loans. Just in and out, and then we'll do what we talked about before, the refinance, where we'll either rate and term or cash out refi after that to pay off the hard money. For construction and improvements, I've only seen the hard money stuff go on, because banks don't like to do construction loans for investors. They just, unless you've got enough assets to go and get a bank relationship to have a big line of credit, that's really the key. If you do have a lot of assets, that's golden right there. You just go get a $2 million line of credit and you just do whatever you want with it.
Well, this might be a vague question. Is there anything else that you think we should discuss that I didn't think of, or that
I think we've actually covered it all. My website's loanwithjen.com as well, so you can get my contact information there, my email, my phone number. People are welcome to call me. And then I'm going to send you that reconsideration of value document, so you could put it in a Google Doc on your, wherever you want.
Okay, you got your Loan with Jen YouTube channel now going, and you're putting some videos out there.
Yeah, I'm putting information out there for buyers and realtors, builders, anyone in the real estate community, whether you're buying or whether you are in the industry. So I've got lots of education stuff on there as well.
And you got a webinar or something that you're doing, or?
I do a webinar once a month, so I have several on there now. But I do webinars for realtors on how to acquire more business, which it could benefit investors as well. And I've also got webinars for home buyers on, how to improve your credit, down payment assistance programs, which would really only apply for a primary residence purchase. But yeah, check it out. Loan with Jen.
All right. You're just doing in Houston, or you can do loans across all Texas, multi-state, or, because I know
we can loan in 13 different states. The main ones that we loan in are Texas, Tennessee, and Colorado, but there are some states like Florida, Louisiana, some other states that we can loan in. But most most is Texas, but we can look at other states. And then I have colleagues from other companies in other states through a coaching program I'm in. So I could always refer someone to a trusted person that knows what they're doing if they're in a state that I can't lend in. So happy to make a referral.
Okay, awesome. All right, guys, what we're going to do is we're going to put all our contact information down below in the description, and go check out our YouTube channel, Instagram, subscriber. So you're going to be putting some good stuff out on those channels coming forward. And other than that, Jennifer, I appreciate you coming on here. Grateful for all the information you gave us. And guys, we'll see you when we see you.